Have you ever wondered why you bought that expensive gadget you never use, or why you panic sold your investments right before they bounced back? What if I told you that your emotions are secretly running the show when it comes to your money decisions, and understanding this could completely transform your financial future? Today we're diving deep into the surprising role of emotions in your financial decisions, and by the end of this video, you'll understand exactly how your feelings are sabotaging your wealth-building efforts and what you can do about it. Let's start with a shocking truth that the financial industry doesn't want you to know. Traditional financial advice assumes you're a perfectly rational being who makes calculated decisions based on logic and data. But here's the reality. Neuroscience research shows that when we make financial decisions, the emotional centers of our brain light up like a Christmas tree, while the logical reasoning areas often go completely dark. Think about the last time you made an impulse purchase. Maybe it was scrolling through social media and seeing an ad for something you suddenly needed. In that moment, your brain wasn't calculating whether this purchase fit your budget or aligned with your long-term goals. Instead, it was flooded with emotions like excitement, desire, or even fear of missing out. This isn't a character flaw or a sign of weakness. It's actually how our brains are wired. For thousands of years, quick emotional responses kept our ancestors alive. Fear made them run from predators. Greed made them hoard resources for survival. Joy reinforced behaviors that benefited the tribe. These same emotional systems are still running the show today, but now they're applied to credit cards, investment portfolios, and retirement planning. Let's explore the big three emotions that control your financial life: fear, greed, and joy. Understanding these emotional drivers is like having a backstage pass to your own financial psychology. Fear is perhaps the most powerful financial emotion, and it shows up in countless ways. There's the fear of losing money, which makes people stuff cash under their mattress instead of investing for long-term growth. There's the fear of missing out, which drives people to buy crypto at the peak or invest in hot stock tips. And there's the fear of not having enough, which can lead to either extreme penny pinching or reckless overspending. Here's a fascinating example from behavioral economics. During the 2008 financial crisis, millions of investors sold their stocks at the bottom of the market, locking in massive losses. Logically, this made no sense. The fundamentals of many companies were still strong, and historically, market crashes have been followed by recoveries. But fear overrode logic. The emotional pain of watching portfolio values drop triggered the same fight-or-flight response that once helped humans escape from wild animals. Greed is fear's flashy cousin. While fear makes you want to protect what you have, greed makes you want more, often at any cost. Greed shows up when you chase get-rich-quick schemes, when you leverage yourself to dangerous levels, or when you ignore warning signs because the potential returns are too tempting to resist. The dot-com bubble of the late 1990s is a perfect example of greed in action. People quit their jobs to day trade internet stocks. They took out second mortgages to buy more shares. They ignored basic financial metrics because everyone was making money. The emotional high of watching portfolio values soar became addictive, and when reality finally hit, the crash was devastating. But here's what's really interesting. Greed doesn't just make you take excessive risks, it also makes you hold on to losing investments too long, hoping they'll turn around. It makes you refuse to sell winners because you're convinced they'll go even higher. Greed distorts your perception of probability and blinds you to risk. Joy might seem like the most harmless financial emotion, but it's actually one of the most expensive. Joy drives celebration spending, where you reward yourself with purchases after good news or achievements. It fuels lifestyle inflation, where you upgrade your spending whenever your income increases. And it creates what psychologists call the happiness trap, where you constantly chase the next purchase that will make you feel good. Research shows that we adapt quickly to positive changes in our circumstances. That new car that made you so happy, within a few months, it becomes invisible to you. That bigger apartment that felt like such an upgrade? Soon it's just normal. But the payments remain, and now you need an even bigger financial high to feel that same joy. This is why lottery winners often end up broke. The initial joy of winning creates a spending pattern that's unsustainable once the emotional high wears off. They make financial decisions based on how they feel in the moment, not on the long-term reality of their situation. Now, you might be thinking, this is depressing. If emotions control my financial decisions, am I doomed to make bad choices forever? Absolutely not. Understanding these emotional patterns is the first step to taking control of them. Here's the key insight. You can't eliminate emotions from financial decisions, but you can learn to work with them instead of against them. The goal isn't to become an emotionless robot. It's to create systems and strategies that account for your emotional nature while still moving you toward your financial goals. Let's talk about practical strategies for managing financial emotions. First, create what I call emotional circuit breakers. These are predetermined rules that kick in when emotions are running high. For example, you might have a rule that you never make investment decisions on days when the market moves more than 3% in either direction. Or you might institute a 24-hour waiting period before making any purchase over a certain amount. The power of these circuit breakers is that you create them when you're calm and rational, but they protect you when you're emotional and vulnerable. It's like having a conversation with your future self, where your rational mind leaves instructions for your emotional mind to follow. Another powerful technique is emotional labeling. When you feel the urge to make a financial decision, pause and identify what emotion is driving you. Are you buying this because you're stressed and want to feel better? Are you avoiding this investment because you're afraid of losing money? Are you considering this business opportunity because you're excited about the potential returns? Simply naming the emotion reduces its power over you. It's like turning on a light in a dark room. Suddenly, what seemed scary or overwhelming becomes manageable. You can then ask yourself whether this emotion is giving you useful information or leading you astray. Here's another game-changing strategy. Automate your good financial decisions. Set up automatic transfers to your savings account. Use automatic investing to build your portfolio without having to make emotional decisions about timing. Create automatic bill payments to avoid late fees and the stress of managing due dates. Automation works because it removes emotions from the equation entirely. Your rational mind makes the decision once, and then the system executes it consistently, regardless of how you feel on any given day. It's like having a financial autopilot that keeps you on course even when emotional turbulence tries to throw you off. But here's something most financial experts won't tell you. Sometimes, emotions contain valuable information. Fear might be warning you about a genuinely risky investment. Greed might be pointing you toward opportunities for growth. Joy might be telling you that you're on the right track with your financial goals. The key is learning to distinguish between useful emotional information and emotional noise. Useful emotions are usually specific and proportional to the situation. They give you information about genuine risks or opportunities. Emotional noise is usually vague, overwhelming, and disconnected from reality. For example, if you're considering investing in a company and you feel uneasy about their debt levels and competitive position, that's useful emotional information. Your gut is picking up on red flags that your conscious mind might not have fully processed. But if you're avoiding all investments because you're generally anxious about the future, that's probably emotional noise that's preventing you from building wealth. Let's talk about one of the most powerful tools for managing financial emotions: the financial vision board. This isn't just about cutting out pictures of fancy cars and beach houses. It's about creating a clear, emotionally compelling picture of your financial future that can compete with the immediate emotional pull of impulse purchases. When you're tempted to buy something you don't need, you can ask yourself, is this purchase moving me closer to my financial vision or further away from it? The key is making your long-term goals as emotionally real as your short-term desires. Here's a final insight that might surprise you. The best financial decisions often feel slightly uncomfortable. When you're saving money instead of spending it, you're denying yourself immediate gratification. When you're investing for the long term, you're accepting uncertainty and volatility. When you're paying off debt, you're sacrificing current lifestyle for future freedom. This discomfort isn't a sign that you're doing something wrong. It's a sign that you're overriding your emotional programming and making decisions based on your long-term best interests. Learning to be comfortable with this discomfort is one of the most valuable financial skills you can develop. Think of it this way. Your emotions are like a GPS system that was programmed for a different world. They're giving you directions based on ancient survival needs, not modern financial realities. You don't need to throw out the GPS, but you do need to update the software and learn when to take a different route. The surprising truth about emotions and financial decisions is that they're not your enemy. They're tools that can be incredibly powerful when used correctly. Fear can protect you from genuine risks. Greed can motivate you to pursue opportunities. Joy can reward you for achieving your goals. The key is learning to be the driver of your financial life, not the passenger. Your emotions will always be part of your financial decision-making process. The question is whether they'll be a helpful passenger giving you useful information about the journey, or a backseat driver trying to grab the wheel and crash the car. What's one financial decision you've made recently that was driven more by emotion than logic? Take a moment to think about it, and consider how you might approach a similar situation differently now that you understand the hidden emotional forces at play. Remember, building wealth isn't just about having the right information or the best strategies. It's about understanding yourself, working with your human nature instead of against it, and creating systems that help you make good decisions consistently over time. Your financial future depends not just on what you know, but on how well you can manage the emotions that drive your choices.